Net net, how does this all come together? It all comes together in what I think is a dramatic risk off that happens over the next 4 to 5 weeks. Much like the end of 2018. Those of you from the crypto markets will remember Bitcoin fell 50% over that period and put in the low. I think we're starting to see that. All you're trying to do in the investment game is put probability in your favor. That's all we do. And it's trying to figure out, okay, how do I get to a trade idea? Most people just kind of bring them out of nowhere and think, well, I just want to do this trade. Maybe it's based on technical analysis. Maybe it's based on some fundamental piece of news. But I do it in a very different way. I take a very structured approach, which is, what is the long-term secular trend? I almost never trade against my secular trends. I'll either go with my secular trend or not at all. Then once I've got a secular trend, the single most important driver of all asset prices is the business cycle. And I use the ISM survey as the guide to the business cycle, which is basically just mirrors GDP, but on a monthly basis. So I use the business cycle to analyze where markets are going. So the year-on-year rate of change of almost all markets is actually the same as the ISM survey. It's kind of a really weird thing, but that's how it works. So the business cycle is the most important driver of asset prices. The secular trend then gives you what you want to do. So secular trends are often, in my world, debt, demographics, technology, things like that. You need to have an eye on those trends. Then you have an eye on the business cycle, and then you get down to, okay, what do I want to do and what trades are there? And then I tend to use technical analysis, sentiment analysis, flows, that kind of stuff to then get the odds further in my favor. So I have a lot of history, and so when has things been similar? And I don't expect a complete repeat, but humans are humans. We react in the same way to roughly the same set of circumstances. And so I tend to look for those kind of setups. So if I can explain all of it, I tend to have a very high probability of being right. But those kind of big setups come infrequently. I'm not a frequent trader. I'm more of a big picture, macro, long-term position taker. The market is currently obsessed by inflation. It's obsessed by the central banks. It's obsessed by interest rates going super high. We saw Bill Ackman out yesterday saying, interest rates need to go up to the moon. I step back from the narrative and start looking at, okay, what is the reality of that? And I think the reality is, and I'll show it in the presentation, that what we've actually done is utterly destroy demand already. We've had the largest rate of change of interest rates in history, the largest rate of change of commodities in history. We've had the largest rate of change of mortgage rates, all sorts of stuff, a very perky dollar as well, a strong dollar. That makes a big difference to this. Those things tend to be financial conditions tightening. We can see it in the equity market. We can see it in the housing market. You can see it in the crypto market. Conditions have tightened dramatically. The market's still looking at the previous CPI prints, and CPI is a lagging indicator. The forward-looking stuff of the business cycle is collapsing. And that's interesting to me because that fits with my secular framework, which is disinflationary, slower growth over time, with this aging population, demographics, all of this stuff all coming together. And I think that it's going to set up for a whole bunch of opportunities as the Fed pivot fast and the economy goes into recession much quicker than anybody expects. So my thesis is demand destruction is what's going on now. Most people have a tendency, economists, people in the commodity markets, most people tend to look at supply. So we know there's a lot of supply restrictions in commodities right now, but people don't realize that the other part of the equation is demand. So most people assume demand is stable and supply is the variable. And I find that demand tends to be the bigger part of the equation. So even if the supply situation is very tight, if demand has been destroyed, then the picture can change super fast. Just to show what I mean again about the fact that the central bank balance sheet drive up asset prices, it's a pretty clear correlation. And I know a lot of people say it's spurious, but my God, it's worked absolutely perfectly. I think of this as actually a decrease in the value of the denominator. If the value of the denominator is, if the denominator is the purchasing power of your dollar, then if you print more dollars, then the purchasing power goes down. That's the supply side of the equation. And the supply side of the equation here, we can see what it does, that the purchasing power of the dollar goes down and assets go up. This is consistent everywhere in the world, everywhere the central bank balance sheet increases, and it works across all asset prices essentially, whether it's gold, whether it's real estate, it affects crypto, it affects stocks. And what's amazing is real estate is so good for this that I've looked at ECB money printing, and then looked at German real estate, same chart, Swedish real estate, Swedish money printing, Canadian real estate, Canadian money printing, US real estate, UK real estate, Australian real estate, they're all the same. So what they're saying is every time the Fed print money, the purchasing power of the dollar goes down, which makes it optically look like the value of these assets are rising. Most of them are actually not rising in central bank balance sheet terms. Now, 2018, I don't know if this chart's going to hold out properly, but it's similar. Is 2018, the NASDAQ looked very similar to the NASDAQ now. It plunged into some final low, a capitulation low. That capitulation low was when the ISM collapsed, the Fed pivoted, and then growth stocks and crypto, don't forget that was the exact low in Bitcoin. And I think we're going to set up for something similar now. The question is how long will this recession be? And that's very difficult to know. I'm using actually 1974 as my basis. 1974, we saw a very similar setup with very high oil prices due to supply restraints. That was the Arab oil embargo. We saw inflation skyrocketing. We saw rates skyrocketing, the dollar going up, and then suddenly the whole lot unwound as the Fed over-tightened and the economy collapsed. And as I said, it went from 56 on the ISM to -30, the fastest recession we'd ever reached. How does it play out for stuff like crypto? Well, the crypto story is still amazing, right? Crypto story is still a technological adoption curve. It's still Metcalfe's law. It's a slow year for adoption, but adoption's actually been sideways. People haven't left the crypto ecosystem like they did in 2018, which is why we've had a much more of a sloppy sideways range. And I think that adoption continues, and if it continues this way, you know, by the time we get to 2030, we end up with 5 billion people or 4 billion people using crypto. This chart's actually been updated since, and we found that the rate of adoption was even faster. Last year, we had about 186% rate of adoption. You can see what that's like compared to the internet. Overall, it's about twice the speed of internet adoption. Even though the internet, as it becomes a more adopted network, the rate of growth comes down, but the numbers become huge. And that's what's important to the valuation of the market cap of crypto. So again, if we look at these updated numbers, even if we assume some slowdown, whether it slows down by the same percentage change that the internet did after year 6, starting at 5 million users, took year 6 after that, it started slowing down to 43%. If we adjust it by the same amount, we get to 76% growth in crypto. We still get to 2.8 billion users in the next 4 years. If we slow it down to match that of the internet, we get 1.2 billion users. And the internet at that stage was at 500 million. So you can see the dramatic increase. And this is what increases the value of crypto. This is Metcalfe's law. This is network adoption. So Bitcoin's adoption was extremely rapid. Ethereum has been much more rapid. And I think some of the other layer ones like Solana have been even more rapid than Bitcoin. And I expect that to continue because the base layer was there. Bitcoin was adopted so fast because the internet existed. Ethereum was adopted so fast because Bitcoin had existed and had been adopted, and the same with the other layer ones, same with NFTs, which were even faster in adoption. If we think of the value accretion to the Bored Ape Yacht Club, for example, it's probably the fastest value accretion to any asset in all history. It's about 250,000% in a year, which is truly extraordinary. I've spent a long time looking at this because a lot of people still don't really understand it. And I thought, how can I model this in a way that makes sense to an idiot like me? Because Metcalfe's law is a complicated formula where we don't have the simple inputs that we can just put it into a model. So I went through all of the different things on chain and the various factors and found that I could best describe the price action of Bitcoin via looking at the total transaction volumes in dollar terms versus the number of active addresses. And that makes total sense. A network of 2 people transacting $1 billion a week is nice, but it's not a network. But the same $1 billion a week transacted by 1 billion people is incredibly valuable. So Bitcoin transacts more volumes than anything else, and it has a lot of active addresses. And what's amazing is the 2 charts, even though the numbers are wildly different, the 2 charts mirror each other perfectly. It tells you that price is actually a great indicator of network adoption. So it doesn't give you a lead, and I'm working on rate of change models and other things to give us some leads on this, but generally it tells you crypto's generally well priced by the market. It's very efficient in what it does. People don't want to believe that. They want to believe that crypto is all about network adoption models that are unique to that particular crypto. No, it's the narrative that builds the network and the utility of the network, but they're all priced the same way. So net, how does this all come together? It all comes together in what I think is a dramatic risk off that happens over the next 4 to 5 weeks. Much like the end of 2018. Those of you from the crypto markets will remember Bitcoin fell 50% over that period and put in the low. I think we're starting to see that kind of scary price action. The equity market as of today has put in a demarket indicator daily low, but this is around the month-end rebalance effects, and we know the month-end rebalance is going to be one of the largest ever, meaning pension funds to rebalance their portfolios have to buy a lot of equities. They're doing that. They probably need to get it done before the long weekend in the United States. After that, I think crypto is telling us it's all going to roll over again, and we'll see the big sell-off. I expect bond yields to continue to rally as they start pricing in the probability that the Fed have to pivot and the economy's gone too far and inflation is broken.